Nicholas Bornoz of Capital Link, and I would like to welcome you to the second panel of our Capital Link Singapore Maritime Forum, which we're hosting this year in virtual form and in partnership with Columbia Ship Management and Singhai Marine Services. As I mentioned, our forum this year is going to focus on three elements: on technology, on finance, and on the human element. So this is the second panel of our forum, and it is going to focus on global alternative finance options. And I would like to welcome Shanna Ghose, the partner of Dickinson, who is also sponsoring this panel. I would like to thank her for being the moderator, and I would like to thank the panelists for being with us today. I will let Shanna do the introduction of the panelists. So thank you to all of you for being with us today, and I look forward to a great discussion.
Right, thank you so much, Nicholas, and good afternoon, everyone. Welcome to this panel session on global alternative finance options, organized by Capital Link as part of the Singapore Maritime Week. My name is Shanna Ghose. I'm a partner of the Singapore office of the law firm Dickinson, and I'm pleased to introduce a highly experienced and interesting panel of financiers and consultants today. I'll introduce them to you in the same order that they're displayed on our screens, and I believe you should be able to see their names and positions at the bottom of each box. So starting in the top left-hand corner, we've got George Kypraios. He's the CEO of Yefira Consulting Private Limited. On the right of the screen, we've got Tobias Bakker. He's from Fleetscape Capital. On the bottom left, George Cambanis from YieldStreet Marine Finance. Right under me, Julian Proctor from Purest Marine, established just last week. And so I'm sure Julian will have quite a lot to talk about that. Bottom right, we've got Axel Siepmann from Bremer Navis Corporate Finance. Welcome, everyone. Just for the audience to know, you can retrieve the full profiles from the Capital Link website on all our panelists if you would like more information on them. So yes, a warm welcome to everyone and to, I think, a few hundred people that are joining us today. Hope everyone is safe and well, and please do make yourselves comfortable for the next 40 minutes or so while we take on this interesting topic of alternative finance options. In order to kick off the session, I would first like to ask each member of the panel to introduce themselves to the audience, to talk about what exactly it is that you bring to the alternative finance space, how you differentiate from traditional bank finance, or if you're more in an advisory capacity, how the deals or transactions that you're involved in differ from traditional financing. So perhaps could I start with George from YieldStreet, if that's okay?
That's great. Thank you very much, Shanna. And thanks to Nicholas for setting this up. YieldStreet is a fintech platform that started in 2015. It acts on the one side like a private equity. We have our own funds. We have warehoused funds that we lend to a ship owner. Once the ship owner has been used that money to buy the ship or fund his activity, we package the loan with the asset-backed loan, and we sell it online to retail investors, accredited investors. We do this in marine, for marine finance, real estate, art finance, litigation finance. So we have a number of verticals. Currently, the platform has 1.8 billion of assets under management and around 250,000 subscribers. And we see our money as opportunistic money. We're quick and flexible, so we are able to fund a project where a ship owner sees an opportunity. We provide bridge financing. It's not long-term financing, so we're not competing with banks. We do up to 3-year terms. And I'll stop there.
Right. What about Tobias? Would you like to go next?
Yeah, we're a little bit different. We at Fleetscape, we are an oak tree sponsored fund or a finance company set up as an alternative lender to shipping and offshore space. We are long-term funders. We are not looking to be a ship owner. We're purely just a capital provider. Average deal for us is 5 to 7 years. $20 to $50 million of funding, but a big range. I think between $10 million on the low end and 150 on the high end. Funding across the shipping and offshore space. I think one of the two differentiating factors, I would say, I think we're quite creative on putting deals together, in the sense that it's not everything we do is a plain vanilla loan. It's tailored to the specific need of the ship owner. And then the other thing is we have a partnership with Macquarie Bank that allows us to get senior financing from them for our deals. They are able to fund us more cost efficiently than one would do for a standalone shipping deal. And we're then able to pass on the benefit of that senior funding to our clients in a blended pricing. So either through a sale leaseback or in the unit tranche loan, we should be able to fund our clients at a pricing between LIBOR plus 500 and LIBOR plus 650 for higher leverage financing than what banks can
do. Any volunteers? Axel?
A pleasure. Axel Siepmann. I'm managing director of Bremer Navis. We were founded in 2009 in order to help clients basically to get the best financing deal. So our daily job is to help clients to get the most favorable financing terms in a complex environment, which means that we help clients to find financings for new buildings that aren't that straightforward, second-hand acquisitions. We're particularly strong in a restructuring environment, and also in complex situation. For example, people that would like to get something financed operating in Africa, so anything that has a degree of complexity is our task. And that is also our passion with 25 people in 4 offices around the globe.
Thanks very much. Julian?
Good afternoon, everybody. My name is Julian Proctor. I'm the CEO of Purest Marine. We are a ship owner of a variety of different types of marine equipment, from vessels all the way over to offshore wind parks. So a wide variety of critical marine infrastructure. We were established by Trust Global, as well as a large number of sovereign wealth funds, government institutional investors. We have the highest quality shareholders. What we look to do as a owner of marine assets is partner with other ship owners, operators across both industrial shipping sector, all the way over to areas such as ferry, seafood, and the offshore wind sectors. So really the entire ocean industries, in helping them grow their business by utilizing our equity. And so often you will see us be very active in forming joint ventures with leading players. We just announced a very large joint venture with Dom Shipyards, which, as you probably actually one of its home bases in Singapore, which we're very excited about. So we're very active. We're going to be also making an announcement, I hope, very soon in the offshore wind space as well. So hopefully we'll be able to do a lot more business in Asia Pacific. Obviously, it's a very important region for us. It's a place where I spent most of my career in life. So looking forward to doing more business there.
Thanks. Last but not least, George.
We're Yefira is a Singapore headquartered arranger. We help mid-market entrepreneurs achieve their growth ambitions, whether it be capex financing, working capital, and also inorganic growth through mergers and acquisitions. In that role as an arranger, and I actually have been a colleague of Tobias in a previous shop, Icon Capital, so we've worked together in the past. But in this current context, our job is to really understand what capital is available, both locally and globally, understand the relevance and increasingly the criteria very specific for each group. Tobias outlined his, George also. So we need to understand how, in that complex environment that Axel talked about, how we can deploy that capital into our transactions. So we work from the business planning through to execution with a particular focus in offshore energy and increasingly in the renewable space as well.
Right. Well, thanks very much. So just turning to our first question then. So alternative financing has had a steadily increasing prominence in the world and in maritime for several years now. But then we've faced this unforeseen pandemic last year. And so I'm curious what your views are on how the industry is, the ship finance industry has sort of managed in the circumstances, and whether shipping is still seen as a strong investment. I suspect, from Julian's perspective, with the huge investment and commitment, I sort of can tell which way your answer will go. But yeah, I'm still curious anyway to hear your views and everyone's views on that.
Maybe I'll then start, given that you just mentioned my name. Which is probably a bit of a for us, what we have seen 2020 is a watershed year in terms of both the ownership as well as the finance of the industry as a whole. If you think about it, there's now a laser focus by both customers as well as regulators on environmental issues, social issues. You can't talk to any bank without them bringing their sustainability team on the same call. I was on a call recently with a large French bank this week, and there were multiple sustainability people because they all wanted to know that the ferries that we were going to be acquiring, they were low emission. And there's this, and I think this is the trend which accelerated post-COVID. There's been this real pivot towards the environment that can create obviously opportunities for some of the alternative debt financiers on this call. But for us, it's an incredibly positive trend because it means the commercial banks that lend to our businesses were very much aligned with where they want to go, because ultimately our customers are large corporates, large ship owners, which we're partnering with, which are the beneficiary of commercial, environmental focused bank debt. So for us, incredibly positive tailwinds, and we're very excited. We also think on the customer side, we've seen a permanent shift in their demands, their expectations, what they want from the ship owners, from their financiers as well. So I think for the part of the market which doesn't take this shift towards environmental sensitivity seriously, I suspect they become much more like a stranded asset player than anybody else.
Has that been, is that consistent with everyone else's experience, or?
Like I could say for Fleetscape, I think the trend we've seen on our side is that, I mean, if you go back to the Icon days, which is now 5 years ago when George and I were there, that was very much a separate thing from the banks. The banks were doing their things, the leasing funds were doing their things. Now it's much more of a sliding scale. And it's not clear where the banks end and the alternative financiers start, and very often they're overlap. I think that's a very new thing. I also think our cost of funding has come down, and I think the bank's cost of funding or expectations of yield has gone up. So it sort of met each other. When we lose deals today, it's not really in the traditional sense to one of our traditional competitors. It's more other financing options are chosen, and that could be a bank, or it could be a public offering, or it could be another fund, or the deal just doesn't happen.
Yeah, right. Interesting.
If I may, paint a slightly more positive picture, because what I find interesting to observe is that, of course, last year in March, April, the world was a little bit shocked, and there was a massive uncertainty. Yeah. But I find that a lot of financial institutions were all taken by surprise how positive, basically, especially the shipping industry developed, coping with the COVID-19 environment, actually in certain parts even benefiting. I mean, look at the container industry that massively benefited, and we have an enormous boom in container shipping as we sit here. And that, from my perspective, led certain institutions to reconsider that actually shipping might be more resilient than its reputation had developed over the previous last 10 years. And we see in particular a few niche banks coming back to the market. I think the big issue here is when you talk about volume. 15 years ago, of course, it was relatively easy to get find a large volume in the banking space. I would say volume is more limited if you look towards bank loans, but I find it's coming back. It's selective, and so far I find that if you ask the question, what has been the effect of COVID-19, a positive surprise in terms of resilience of the shipping industry is my take from it.
So basically what I'm hearing is that, shipping is still seen as a safe, strong sort of industry, notwithstanding that big curveball we were thrown last year. But coming back to sort of something Tobias had said about how, nowadays, there isn't this distinct line between sort of the bank finance and alternative lenders, and how now it's, you don't just lose out to the other, it's to what, other alternative options there are. So it seems to me that basically alternative finance now, it's not just plugging a gap anymore. I mean, it's this permanent feature, it's here to stay. I mean, we see it now in sort of even the Lloyd's list, top 10 rankings that come out every year, that we're seeing more and more sort of alternative financiers featuring there. So, I guess the question is, would you agree that it's more sort of mainstream, and what do you see sort of in the makeup of players in this market going forward?
I think, Shanna, shipping has never had it as good. There's so many alternative players in the market today that each approach the shipping industry in a different way. So there's different types of funding, different terms, some are longer, some are shorter. There's the opportunistic funding that we like to provide if a ship owner wants to buy his debt back from a fund and needs a relatively high advance quickly, then we can give that to him, and he can go and take his time to find a bridge loan and pay us back. So there's a lot of choices, I think, in finance today for ship owners.
Yeah.
Just to follow up on that, I think to some degree alternative financiers will still be the filling the gap, if you will, because there is very often an equity need that's not being filled in shipping, but in a much more of a creative way. It's just not filling the gap. It is more providing a complete solution for projects that are developed.
Yeah.
And I would also say that there seems to be an increasing amount of commercial bank debt if you're a really high quality customer. There's no doubt it's never been better. And the terms that some of our partners, shipowner partners, operator partners see are phenomenally, I don't think I've seen since 2004, 2005. I would also support Tobias's view that for product providers like himself, financiers like himself, there's a segment of the industry which is incredibly attractive, and both Tobias's business as well as businesses like Entrust's credit business are doing incredibly well. They're doing phenomenal. There's lots of customers for them. But there's a fundamental shortage of equity. If you look at the amount of public issuance in the industry over the last several years, you could count on one hand how many IPOs there have been in the last several years. There is no public equity which is financing shipping, probably outside of places like Japan and China. And that's often driven for very different reasons. So for me, that is the fundamental challenge, which is we know that there's trillions of dollars of capital expenditures which are going to be required over the next decade to rebuild the fleets that we have. We know that the banks are there, the commercial banks are there. We also know that there's, in some cases, alternative financiers. But where does the equity come from? And ultimately, that means you need more people like us to fill that gap, because there's just not enough equity. And that's really, I think, the message for people here today is if you need to think about where these big issues are, that's one of them which I would really put a laser light under.
Yeah. And just to add, I come from the other extreme, which is the middle market space. And I think everything that Julian says is absolutely correct. And I do share Axel's optimism. But pre-COVID, it wasn't anything to do with COVID. Here in Asia, we saw a wholesale departure of European banks from the market. And if you are BW Offshore, or if you're a Costco, if you were some of the companies that Julian's involved with, no problem, as he said, cheap as ever. Our problem now is that you've lost a number of creative structuring people from those institutions. And yes, some are coming back in pockets, but for the middle market in Asia, that critical piece of whether it's 30%, 40%, 50% debt at single digit rates to make the overall deal work is actually very tough to get for the small and medium-sized market. Sure, that's going to lead us to consolidation issues, but for projects, it's getting very hard, and that's why it's fantastic to hear the sort of things that the unitranche structure that Macquarie and Fleetscape are doing. The challenge for us is a lot of the shipping in Asia is offshore energy related. Everyone is focused on sustainability in those markets and is very focused on renewables, but it's very tough these days to get any sort of financing for offshore energy in the again, middle market in Asia.
Okay, I'm going to move on now, just in the interest of time, to sort of just a little bit more into sort of the reputation of alternative financing. Is it, so traditionally, I guess the view that the market, the industry has of it is, yes, you have these unique structures, you know, it's flexible, you can get sort of higher loan to value coverage, but at the end of the day, it's more expensive. So is that a fair view? Is that too simplistic? Is it outdated? What can you tell us about that?
Well, let me jump into that one, because I think it's a truly sliding scale. And I think the higher leverage you get, the more you pay. It's really no difference. And I think, yeah, if you want 90%, 95% financing, it's going to cost you. It's going to be expensive, and it's going to put pressure on the economics of the underlying transaction. But it doesn't necessarily mean that it's uneconomical to do a project with 70% financing. It should be able to carry it in shipping. And also, this is a function of cycles. I mean, I think going back to before the financial crisis, banks were doing 80–90% of the financing on top of the market. And that was not sustainable. So it depends on where you are and what the expectations are for the underlying project, and what the expectations are for where asset values will be over the term of the investment.
And that high LTV, there's an equity element. So, the ship owner goes to a bank and gets a 50% LTV, he has to put in 50% of the money. But if he's getting a 75%, that 25% has to be paid for. So, as Tobias says, it's part equity, part lending.
Right. And is there sort of, there's so many different structures now, that are out there. Is there any sort of particular way, preferred approach, or, are we looking more towards sort of sale and leasebacks these days, or just normal sort of debt structures? Just the usual sort of mortgage lending. What are we seeing these days in terms of what the options are?
Let me jump in here. I mean, it has become extremely diverse, and there's a multitude of structures that actually compete against each other. There's a few players that are very successful offering leasing structures, and we see very competitive terms, especially in Asia on that front. There's a few owners that simply don't like leasing structures because formally, legally, they don't own the ship, so they turn towards those players in the market that provide basic mortgage-backed loans, senior and junior loans. But I think the important take is that today we talk about very rational risk-adjusted pricing, and the strengths of alternative financing is that it's free of regulatory constraints. It can basically jump in where banks simply don't feel comfortable. For example, in a restructuring environment or in a situation that has been distressed, a lot of banks categorically say, sorry, no, we're closed for this type of exposure. And alternative financing can take an own view, what they believe is the outlook of the asset and the counterparty, and then take a situation and respond relatively flexible. So we see, the same type of alternative financing institution providing quite different terms depending on what the counterparty actually is. And then so far, I think there's the risk-adjusted pricing is really, I think that's what has developed over the last few years, and arguably, I think that was pre-Lehman crisis quite different.
Right. Actually, that ties in really well with sort of what I was going to move on to next in terms of sort of regulations and the flexibility that is enjoyed in the alternative financing market, sort of being a little less free from that. So, it's a generally sort of hot topic, compliance and ESG, and which we've seen piled on the banks basically in recent years. So, from what you were saying, it sort of it lends sort of to the point of view that the ship finance banks are basically becoming less competitive because of it. Could you give us a little more on sort of how the alternative financiers sort of navigate these regulations, and how do you stay flexible as a result?
Well, if I can answer from the investor's perspective, every investor today asks a question, just like Julian said. I mean, this is if not the first question, one of the first questions they will ask for any kind of conversation. That being said, I think you still are finding capital for every kind of investment in shipping, regardless of the ESG footprint. It just becomes a very differentiated cost base and very differentiated structure expectation, which is part of the reason I think, George, you're referring to it in Singapore, the offshore space. I mean, there are a lot of the traditional banks just don't want to touch anything that makes them look less environmentally conscious.
That the ESG question is an interesting one, in that a whole slew of new fuels, new designs of ships, new propulsion systems need to be developed, and a lot of money needs to be poured into R&D for this development. And the world has never been in a better position to solve for this with technology. If we see with COVID, it took the world less than a year to come up with 2 vaccines because of technology. And it happened because everybody put shoulder to the wheel. Everybody lent in, the universities, the governments, the industries. Everything we touch every day probably came on a ship. Everything we eat, wear, but the people aren't aware of that. And I think there's a job to be done to get that message out there, and for industries and everybody to lean in. And it's very, very great news today. Mr. Ong, the Minister of Transport, announced that the MPA of Singapore is putting up a global maritime decarbonization cluster in Singapore. So like-minded companies and incumbents can figure out what needs to be done, because the ship owner can't solve this. The ship owner is the buyer of equipment and the buyer of fuel, and his job is to transport keep the global supply chain going. So it's really encouraging that this is happening and that people are starting to become aware of it.
Julian, do you want to add anything? Or,
I mean, look, my view, as I've said before, was the customers have already shifted. So all of the big customers, whether or not you're Maersk or Rio Tinto or BHP, they are already making it very clear what the ship owners and the ship operators need to do, which is increasingly provide low carbon vessels, which is what they want. The other reality is that the technology is now commercially available. Maersk and people like Trafigura are heavily focused on ammonia fuel systems, which will become commercially available in 2024. And if you think about it, that's only 24 months away. So already we will have engine systems which will have the capacity, the capability to ultimately burn zero carbon fuels. Because when you produce ammonia in the right way, obviously there's no C in NH4, which is ammonia, so you've got a clean fuel. So the systems are here today. The challenge is, how do the big companies finance that transition? And ultimately that's something which we are well looking to support. Our entire business, our entire focus is really about the energy transition. It's about supporting those big ship owners, those big operators, make the move to those increasingly low carbon fuel systems. But the great news again is we're completely aligned with what the customers want. They've told us what the regulators want. They've told us, and the technology is here today. So often when we hear that there's uncertainty regarding which direction the industry is moving, I think we need to just look at the realities, which is the very large players have already made those decisions. They've signaled it to everybody. It's just that there's a lack of capital, which is prepared to support that in the case of some medium-sized ship owners and operators.
And that's a good point, just to segue in, that end of the day, picking up on Julian's couple of points around what you said now and before around equity being the key. There are a range of interesting funds, particularly in the UK, which are focused on growth and not necessarily equity in nature, but they target a certain return and flexible about how they get there. It is about cash flow first, second, and third. The second thing is about the management team. So if the management team has a real thesis, I think they will support that case. The actual steel itself is the least of the considerations of some of these players who cannot, and I for one don't know what the right fuel is, as long as there's interoperability and you can flip an engine between ammonia and say something else when needed. I guess that's a flexibility. So there are a lot of capital out there, equity and non-equity, which are focused on both ESG solutions, but also supporting good business ideas. I think that the message is positive. I guess from an Asian perspective, being here in Singapore, we need more things like Clifford Capital, which has been specifically set up to help long-term developments, has a Singapore element, and things of that nature to fill the absence of certain senior debt, and try and encourage some of the innovation that you really see in America, Germany, and the UK to be based here, for particularly around that debt component, because we have very good equity people in Hong Kong and other places. It's just that I think the key for us in Singapore is getting that debt, which I don't see as being competition from alternative equity. It is a complementary nature to achieve the results that our clients want.
If you are...
By the way, sorry, Axel, I didn't mean to cut across you. Just one point beforehand, George. This is a phenomenal opportunity for Singapore to really take a leadership when it comes to green finance. You know, London has taken and I've come to London now for the last few months, a phenomenal leap forward in green finance. But in Asia, there really isn't a financial capital which is showing that leadership. And given your natural maritime complex and the skills surrounding that in that ecosystem, there is a unique opportunity for the MPA for Singapore to really provide that leadership. And I think you've got to grab it. So I'll be emailing the MPA soon.
Okay. And me.
And George.
But if you listen to this panel and actually read the papers as a ship owner that owns a 7-year-old dry bulk or tanker, you could actually get the impression that, well, will I have a problem basically refinancing my ship in 5 years' time down the road, because everybody now talks about ESG, etc. And let me ease the concerns. I'm deeply convinced, yes, it will be no problem actually even finding, bank financing for this type of exercise, simply because what we're talking now about concerning ESG and future propulsion system, that's the innovative part of the market. And I think the very strong, large players, will come across that segment first. But 95% of the market at the moment is still on traditional propulsion system, traditional fuels, and will be for quite some time. The biggest gain, besides, would most probably come, in terms of carbon emissions from slow steaming. And insofar, when we talk about alternative financing, I would say it might actually even be an opportunity for alternative financing to support, traditional ship owners to refinance the assets. Should banks actually move out of the sector of financing traditionally fueled ships, which at the moment, I must say, I doubt, despite the fact that it's a very positive development that a lot of investment thought goes into how to reduce carbon emission, develop new fuels, and actually build new ships. That will be no doubt a massive opportunity going forward. But let's not forget, most of the people that actually watch this panel most likely still own a traditional ship, and they shouldn't be afraid.
I mean, just to follow up on that, Axel, I think, yes, the money will be there 5 years from now. We will certainly be lending to traditional ships 5 years from now, but there will be a clear differentiation on pricing and structure. And that's not necessarily because funds such as ourselves or others treat it differently. It's a function of how we fund ourselves. And when banks look at us, it's no different than their conversation with the shipping company. They will have one set of parameters for environmentally friendly assets and one set of parameters for traditional assets. Whether it's directly with the shipping company or directly with somebody like Fleetscape that we then pass on to our clients again. So I think that gap, there is a gap today between more fuel efficient ships and less fuel efficient ships. That gap will continue to grow, but the capital will be there. That I agree with. The capital will be there. Correct.
Right. I did have one last question, but I also got a message saying we had 2 minutes left 1 minute ago. So maybe I'll just quickly ask it, and you can just give me some buzzwords before we end. Just in terms of the future, what are we concerned about? What are the uncertainties or the threats? Could you just, maybe just, in a few words, tell us what you think they are?
What does the new normal really look like?
I also think this is a people business. We have to meet physically, and if we're not capable of doing that, it will be much more difficult to get a hold of capital in the right way, get the right deals done.
Yeah. Right. So I've just got a message saying time's up. Yes, indeed. So all that remains for me now is to thank all our panelists. Thank you so much. You've been great and engaging. And I've certainly learned a lot. I'm sure our audience has. And to our audience, thank you very much for participating in this session. As I mentioned, if you need to reach out to any of the panelists, you can get their contact details off the Capital Link website. So thank you, everyone.
Thank you. Thank you, Shanna. Thanks, panel.
Thank you very much.
Thank you, friends.